Grant Reaves joins me, and you could learn what his team is up to by going to stoicep.com. That's going to be a clickable link in the show notes. You can find him pretty active on LinkedIn as well. So Grant Reaves for that, but stoicep.com. And we're going to be talking about multi-tenant flex industrial. And this is kind of a niche conversation, but there's going to be a lot to learn here. So really appreciate your time here, Grant.
Yeah, thank you for having me today.
Well, this, like I said, this is kind of a niche thing. So how did you find your way to this?
Yeah, so kind of going back full story on getting into real estate from the beginning. Was in college and I guess it was around 2012, 2013, and was having way more fun than actual going to class. So quit going to school for a little while, came back home, tried to figure out kind of next steps of what I was going to do professionally. And through that, had somebody suggest to me to get my real estate license. And so started as a realtor selling houses. We're down on the Alabama Gulf Coast, so near Mobile and the Florida Panhandle is kind of where we're based. And so starting in 2013, sold houses as a 21-year-old. That was fun for about 6 months and quickly transitioned over into commercial real estate brokerage, which is what my long-term career has been in. And so starting, I guess, in 14 until just recently, probably 2 years ago, I primarily sold limited service hospitality. And so this was Hampton Inns, Holiday Inn Expresses, Comfort Suites, those type of buildings or properties throughout the Southeast and kind of throughout the country. Started off with kind of a regional commercial real estate firm, then moved over to Marcus and Millichap and their national hospitality group. Met a good friend of mine, Jeremy Friedman, who's now my business partner in Stoic. And we always talked about raising money, doing our own deals, whether that's development or value add acquisitions or kind of whatever we could find. And really through COVID is really when that came to be. We were a little bit slower on the brokerage side. I mean, there wasn't as much going on, right? And the phones just slowed down, that kind of thing. So we came to put our heads together and come up with a plan of what we would want a firm to look like. Started chasing deals into 2020. Closed our first one in July of 21. It was a self-storage deal. It was a conversion from a grocery box to interior climate control self-storage. We then went on to do three more self-storage deals, about 200,000 square feet of storage. We have two here in Alabama, one in the Florida Panhandle and one in Arkansas. But then it was early 22. And through that, I mean, anybody who was investing during that time knows that a lot of markets were getting really, really overheated. There was a lot of supply coming in. And it was for a smaller group like ours, it was a little bit harder to scale and compete in that asset class. So we started looking around and figuring out kind of what is the best supply demand kind of metrics. Like what are people not building that is still in demand? Like obviously the easiest would have been office at that time, but that's not the direction we were wanting to go. Kept talking to brokers, kept just kind of relying on our brokerage experience as well, and came back to flex industrial. So kind of to define that, it's a multi-tenant building. So usually let's say 50 to 150,000 square feet. It's made up of call it 20 to 30 tenants that are, 5,000 square feet, 6,000 square feet units, maybe down to 3,000 square feet. And so like that 3,000 square foot unit might have 1,000 square feet of office and 2,000 square feet of warehouse. So it kind of looks like an office front with a roll up or dock high on the rear. And so we had seen that none of that product was really available on the Gulf Coast. And as we kind of researched through going in Q1, Q2 of 22, we really figured out that there wasn't a lot of that product in a lot of these growing markets in the Southeast. And so we made a conscious effort at that point to really change our investment strategy and go after flex industrial. And that's what we've done. So I guess we bought our first asset September of 22. So almost exactly 2 years ago to today. And we've bought approximately 800,000 square feet of that product. We'll buy another 200,000 square feet this year. So about 90% of our portfolio is multi-tenant flex industrial, but it's a really good space for us.
Could you kind of give us an idea of the customer avatar here or the persona? Like who is taking advantage of this type of space?
As far as on the tenant side,
You're right.
yeah. So we have some larger like distribution type clients like UPS, FedEx. We have a lot of home services businesses, whether that's national, like a Terminex or a foundation repair company, large contractors, but we also do have kind of more local mom and pop, like HVAC contractors, plumbing contractors. We have some life science type space, like Tyson's Chicken has a unit in one of our facilities and they do food safety testing of their packaging for their chicken. So yeah, it's a pretty wide gamut of different users throughout, but a lot of them come back to kind of the home service business overall.
That sounds like a very steady Eddie type businesses that you're catering to. Like, yeah.
It
You
is,
know, a
and
lot of
it's needed product in growing areas where there's a lot more housing coming in. We're usually going into southeastern secondary cities that where the new Targets, the new Starbucks are being built, and we'll go invest near there. And then that's really another part of ours. Like while we do have a small office component to our buildings, if you need to have 50% plus of your workspace be warehouse, like you can't really go work on your Zoom, right? Like you have to have a place to manufacture, store, ship, whatever you do. You got to have a physical location. So it's kind of protected from that work from home trend as well.
so if you're looking at an opportunity like this, what is your buy factors? What are you doing to or researching to make sure it's a good fit?
Certainly. I mean, the biggest thing is it's whatever the asset class is, right? Like whether it's multifamily is what most people are aware of. But I mean, at the end of the day, it's value add investing. So you're finding deals that need some lipstick, some renovations done to them. If their rents are below market, and so you're buying them with below market rents with some cash flow, doing the renovations, getting the rents to market overall, right? So what we're really looking for are deals that are well below replacement cost. So replacement costs of these assets are somewhere in the 140 to $160 a foot range. In our portfolio, we've bought on average about 92, $93 a square foot across the board. So we're buying well below what it would cost to replace the product. And then we need to have upside in the rents. We're not a group that's buying, 100% stabilized market rents, seven caps. That's just not what we do. We're looking for deals that are maybe sitting there with $5 to $7 rents in a market that is 10 to 12. And we can go in and buy that asset for 7 million bucks, put $1 million into it, and then make it worth 10 by pushing rents, right? And so that's really what we're looking for is that upside. The big thing in Flex also is the fact we want to be in markets where you can't build this product. So the higher end of rent ranges we see is about 12 bucks a foot. To build new product in the market, you would need to be like 15, 16 because of construction costs. So that's a big thing we want to look at. We don't really want to go into like the super hot markets where rental rates are high teens, because then you could have new supply coming in on top of you. But with where we sit, we want to be in the markets where you don't have new supply coming in.
You mentioned that you are trying to find places that are kind of below market.
Mhm,
More times than not, in my world, when we're talking about rental property, that's typically being purchased from like a mom and pop who
mhm,
just doesn't have the incentive. They're not incentivized to raise rents with the market. You know, they got the property paid off or
yeah.
what have you. Is that the similar situation here? You finding it that it's mom and pop owners that aren't
For
keeping
the
up with
majority,
their local trends?
yeah. And so like a lot of our owners are, yeah, like I said, mom and pops that maybe bought these assets in the early 2000s or even late 90s or even built them in the mid 90s, and their basis is so low in them and they're paid off, as you mentioned. So to them, they're looking at that going, yeah, I mean, we're making a few $100,000 a year. Why would I rock the boat and create a lot more work for myself when I can just continue to get cash flow? And to us, we're like, well, that's great that you're making 300 grand, but you could be making 600 if you just did a little bit more work. We have also bought from larger operators that like in the industrial world, a lot of the money is chasing what we would call bulk industrial. So that's, your 400,000 square foot facility that's made up of three huge international tenants. And a lot of times those owners, whether it's a REIT or just a large PE shop, sometimes they'll end up with a flex piece. Like maybe they bought a portfolio and it had a flex building in it, but they really just wanted the larger industrial. And so we'll buy the flex off of them. We've done that before as well. And so, kind of the first thing that we always do is we're always making the aesthetics look better. I mean, these are, if it needs value add, it's probably going to need some new paint, new roofs, redoing the parking lots, upgrading the landscaping, just kind of freshening up the exteriors. On the interiors, it's pretty simple. And usually it's new LVT flooring, some paint on the walls, maybe upgrading a bathroom a little bit. But I mean, overall, it's pretty simple build out on the interiors, right? These are 1,000, 2,000 square foot offices that have maybe a conference room, couple of private offices, a bathroom or two. So they're pretty simple renovations compared to like a multifamily or single family that, you're redoing kitchens and a lot of bathrooms and all that kind of stuff, which is nice. Another renovation thing that we do on select buildings is we'll be tearing out office. So we bought two specifically that were lower occupancy deals, but all the vacancies were like 80 or 90% office because prior to COVID, right? Like you could get a lot more rent for an office suite than you could an office warehouse suite. That is obviously flipped. And so we bought those facilities, gone in, done some demolition, pulled out that office, increased the warehouse percentage, and have been able to drive up the occupancy by doing that. So that's been an interesting strategy as well.
What do you have any kind of particular market focus? Where are you primarily buying these properties?
Yeah, so we buy in the Southeast, primarily a little bit more in stabilized markets. So like We don't really play in like the South Floridas, the Orlandos, the Nashvilles. Those are great markets, but as far as our world, we kind of see it as an ability to be able to buy a little bit better yield by going to like the Birmingham, Alabamas, the Northwest Arkansas, Little Rock, Arkansas, Florida Panhandle, just a little bit more under the radar. These are, markets with a million and a half people in the MSA. So they're not in the middle of nowhere, but they're not your boom towns because at the end of the day, I feel like a little bit more of your return profile in those quote unquote boom towns would be a little bit more appreciation driven than just buying in place. You're kind of betting on that continued growth, which is great and works for a lot of people. It's just a little bit different in investing style. I'd rather buy seven caps that I can get to 10, 11 yield on cost rather than buy five caps that I can get to 7.5 yield on cost, right? It's just a little bit better spread.
So, do you have teams, boots on the ground in each of these markets?
Yeah. So we use third party property managers. That is one nice thing about commercial is that, traditional commercial real estate brokerages also do management. So usually in most markets, there's usually one or two groups that really focus on flex industrial, and that's who we'll use. So say in Memphis, Tennessee, that's going to be like a Cushman Wakefield is really popular there in the flex space. In Little Rock, Arkansas, we use Colliers. In Jackson, Mississippi, we use NAI and then a local group called Pinpoint. And so it's really just finding whoever's running with that product type there locally, which is also how we sources our deals, which is really nice too. Flex is a very localized market. It's kind of like I would compare it to service-based retail. It's not like you have some big, Marcus broker, CB broker, or whatever in Atlanta selling product all over the country. If you're selling flex or especially leasing flex, it's local. And so you're based in that town that you're working in. So for us, what we've done is gone to the markets we want to play in, and we have our list of 10 to 15. And we've gone in and met those brokers that play in that product type, made sure they understand what we like to buy, shown them product in their market of like, hey, if you can get this owner to send us their stuff, we'll make an offer on it. And that just makes our sales process much easier. I feel like we talk to some people that have teams of cold callers out there just calling sellers, and that's a great strategy. But for us, we found that it was a little bit easier just to go straight to the brokerage community because these guys already had relationships with these owners. And so rather than us trying to go make a relationship with Dave, the owner who we don't know and he doesn't know us, we're from 4 hours away. It's a lot easier just to have the broker call Dave, who he's known for 10 years, be like, hey, these guys from Alabama want to make an offer. Just builds that trust a lot easier.
Well, let's add on that then. The broker relationship there. How did you find it to make sure that you're building such a strong relationship? I'd have to imagine you're kind of putting your best foot forward so that the brokers don't just blow you off.
Exactly. And fortunately now we have been able to do enough transactions and have enough size that it's like, this is obviously what we do and what we like to transact on. And we have enough of a track record that brokers can believe that, hey, we're going to get it to the closing table. But it really just came down to just really selecting the markets and being a little bit more selective and targeted on where we wanted to go. Hey, we want to buy in Jackson, Mississippi metro, because at the end of the day, we see a lot of industrial tailwinds happening there in the suburbs outside of the main city. And so it was going directly to that market, going on LoopNet, Craigslist, driving around, figuring out who signs in front of all these flex deals, who's doing all the leasing. Because whoever's doing the leasing is who has the relationship with the owners, and taking those guys out to dinner, making relationships with them, making sure we're talking to them regularly. And myself and Jeremy started out really doing a lot of that. Now we have an analyst, his name's Sam, and he works on my team and he runs a lot of those relationships now. Advice for people is, working with brokers, the biggest thing is giving really fast feedback, whether that's a no and telling them why it's a no. Just from our brokerage days, we always knew that that was a big thing. If you want to see a good deal flow from brokers, you need to be able to give really quick feedback and especially be able to explain why you're not going after an opportunity so that they can bring you better opportunities later on.
And everybody stick around here as we're about to jump into building that relationship with a property manager and the economy regarding commercial property. But before we do, I'm going to ask you for a quick favor and share this episode with one of your investor friends. If you're watching us on any of the YouTube or Rumble channels, do us a quick favor and do a like and subscribe. And one last mention of head over to stoicep.com if you want to learn a little bit more about his team, Brett's team, and how you can get involved. If you're watching us on YouTube or Rumble, do us a quick favor, give us a like and subscribe. Head over to stoicep.com to learn a little bit more about what Grant's team is up to and how you may be able to work with them. So, Grant, with all of that, there is this juggling act when you're dealing with property managers because property managers and your interests aren't usually aligned. Let's
Yeah.
just be honest. How do you find the proper property manager in order to make sure your interests are aligned and you're getting the service that you need?
Certainly. And to that, I mean, I think that they want their interests to be aligned. They just think that the property management is a volume game and you have to be able to run a bunch of product to be able to make it a cash positive business venture. So really the biggest way that we handle that is number one, we pick professionals that have good reputations and we make sure to check references to other owners that they work with, that kind of thing. But also, frankly, it's a little bit of just being the squeaky wheel, right? Like the squeaky wheel gets the grease kind of thing. And so we have an in-house asset manager and an in-house controller that work with those third-party property managers. And so Matt, our asset manager, he syncs monthly with every single property manager. He syncs weekly with a lot of our leasing agents. And it's just a lot of not necessarily staying on top of people, but just making sure that things are front of mind, right? And so I feel like where people go wrong with property management is like property managers just have so much going on. Like there's so many, and every task is kind of smaller, right? Like it's like make sure that this flower bed gets redone, or make sure that this contractor shows up to this. It's smaller kind of tasks that are really easy to be left by the wayside. And so I feel like the best way to do that is being really organized with the property managers. Matt's big thing is that he is very organized with his property managers. They have action lists, they have to-do lists, and then they also have very regular meetings to review. This is what's happening. This is what needs to get done. This is what's supposed to get done that did, and make sure that you're just really on top of that process. Not to be a pest and not to be overly bearing, but just to make sure that we're all working in the same direction day in and day out, which is the most important piece. But yeah, you do have to find the right ones, right? There are certain ones that are a little bit more plug and play that don't really want to go through that process. I mean, if you're doing a value add deal and you're pushing rents and you're pushing value, you don't need someone who's just gonna make sure the grass is cut once a week. Like you got to have really on top of the property managers to make sure that like they're pushing the ball forward every single day. That's what you're trying to do with the property.
The squeaky wheel gets the grease, right? And you do have to help and stay top of mind when it comes to
You
that
do.
type of thing.
Yeah. And I think that being friendly with it, I mean, you don't have to be a jerk about it. You know, just make sure that it's really just organization, right? And making sure that you're sending follow up emails on, hey, please get this done by the 5th, and then send an email on the 6th. Hey, did this get done by the 7th? And just making sure that they know that you're going to be on top of it and you're going to be watching what's going on.
Jumping to the economy, one of the things that I've been thinking for a while is that in my market anyway, we're still seeing the remnants of what happened during COVID. We have a lot of storefronts sitting empty. There's a lot of large retail space that there's no use for at the moment that hasn't recovered. I keep thinking that if somebody can repurpose some of the space, there's some gold sitting there.
Yeah.
Earlier, you mentioned repurposing some property for this flex purpose. This Are you seeing that this is possibly the route for that
Well, that one
type
that
of
we
space?
actually repurposed was a large retail, but it was to climate controlled self storage. That was not to flex industrial. But to answer your question, I do think that retail strip centers do lend themselves to be able to be transitioned into flex industrial. I mean, the biggest thing that you have to watch for those is on the rear of these buildings, right? You need to be able to have a big enough truck court that trailers and trucks and stuff can get back there to be able to get to their warehouse portion. A lot of strip centers are built up against the back of their property because they didn't really need to have a lot of access there. So not everyone can be converted, but for the ones that can, that's great repurposing. I mean, at the end of the day, flex industrial, again, there's not enough supply. It's a lot of demand on the product. And so that is a good avenue to take that product type. It's just got to be the right building. But I mean, these buildings are pretty simple, right? They're metal buildings or tilt wall construction or masonry. I mean, and they're have walls in between that you can move around. So I do think the retail to flex is a possibility and a good way to be able to get in lower than building ground up for sure.
If somebody is interested in doing this type of thing, can you kind of give us a little breakdown as to what would be the benefit of seeking out a company such as yours and doing something more passively when it comes to investing versus trying to tackle a project on their own?
I can tell you this, it takes a lot of time. I mean, we have a team of 7 dedicated people that work 50 plus hours a week doing this. I mean, it is not a passive deal, right? And you can say that. I mean, you're from the single family world, you know that better than anybody, right? That is very hands-on and very operationally heavy. And also, I would say to invest with someone like ourselves to be able to get a lot larger deal flow. Like we're able to get people involved that maybe only have a couple hundred grand they want to invest, but they can get into 5 deals throughout the Southeast, and that might be $50 million worth of product. And so, if they portion that out over a few deals. And so then it gives you the ability to do a lot larger deals, a lot more institutionally quality deals, and also be able to have operators that are pushing the ball forward rather than you taking time away from work or whatever to have those monthly calls with property managers.
Can you kind of give us a snapshot? What is Stoic's short-term and then long-term goals? How do you see the company progressing?
So right now we currently sit at about 95 million of assets, about 950,000 square feet. We'll buy another 100,000 square feet next week, which will put us over a million, which is a big milestone for us in our portfolio. Looking forward next year, we would like to buy another 100 million in assets. We're about to launch a new fund to be able to target that. And so we'll start that next fundraise. And so long term, we're going for $1 billion worth of assets by 2032. That's kind of our 10-year large target. And so to do that, we need to be able to continue to grow. So next year that'll be another 100 million and just continuing to add more properties and build out. Really, that comes down to building out the asset management team to make sure that we're managing everything correctly.
As you've been scaling your business, what has been the biggest surprise?
Primarily how much cash it takes to scale a business, especially in real estate. Like, we kind of knew that going in because we were brokers, but like that's been a big thing to work through is if you're going to go scale and you're co-investing alongside your investor, you're putting out earnest money, you're doing pursued costs. I mean, you have hundreds of thousands of dollars out at all times. And so while real estate is quote unquote a cash flow game, being in the private equity real estate space can be cash flow crunch just because you have a lot of pursuits out there to be able to continue to grow and grow. So that's been a challenge, but something we've had to work through.
What is your typical exit then? You buy a property, how long do you typically hold it, and what is your strategy on exit?
Yeah. So currently we have not exited any of our assets. We started only in 22 buying this asset class, and these are 3 to 5 year holds. So that is one thing about flex industrial is like, it's not like a self storage or even a multifamily where you have monthly or annual leases that you can roll really, really quickly. These are typically 3 to 5 year lease terms. So it takes anywhere from 12 to 36 months to be able to roll enough of that rent roll to really be able to create that extra value. And so kind of our typical investment strategy is going to be buy it, have 1 to 2 years of kind of limited cash flows just as we work through those rent rolls, work through the renovation process, have good cash distributions years 3, 4, and 5 as we continue to push up rents, and then sell in year 5 is our anticipated timeline. So we're about halfway through that on our first assets. We might look to sell some of these here soon just to go ahead and start recycling some deals. But right now, it does take a little bit of time to work through these business plans and improve them out.
One more time, head over to stoicep.com to learn a little bit more about the projects and experience there. Grant, is there a question or concept you wish we would have covered so far before we jump into the rapid fire?
No, I think we hit everything pretty good. Unfortunately, it's a simple strategy. It's just supply and demand and buying office warehouses, right? It's exactly a lot of work, but simple to concept at least.
Well, if you're ready, we'll jump into the rapid fire. What lie do real estate investors sometimes tell themselves?
I feel like sometimes people or put too much emphasis on cash flow. If you really look at where a lot of money is made in real estate, a lot of it is on property appreciation as much as it is cash flow. And cash flow is awesome. And like, that's why we do this. But there is a certain point that I think people need to look at like property appreciation for the people that have really made a lot of money in real estate.
If you could go back in time and give your younger self one piece of advice, what would it be?
I was always in commercial real estate. I would have started buying commercial real estate and started investing a lot earlier. I started when I guess I was 29. I would have started 24, 25, whenever I figured it out. I just sat on the sidelines for too long.
Curious, since you were in brokerage,
Mhm.
you've experienced this. You're working with these individuals that are buying and selling these properties all the time, seeing the money that's being generated. Why don't we see more people in those roles jump in as well?
I mean, a big thing for me was really a lot of timing. And so I got in, I guess, in 2013 and then through the recovery. Frankly, you heard just tons of horror stories from all your broker buddies that were like, had all these clients just absolutely got smashed in '08. And so there was just a lot of fear out there, which granted, now there's a great time to invest, like most times when people are fearful. And so, yeah, that was a big piece of it. I think that's a big part of it is you see as a broker, you see a lot of deals that don't go great. And so you do have a little bit of a hesitancy, or at least I did have a little bit of hesitancy to be like, man, that looks tough. I don't want to be that guy going through that workout or something like that. So
Do you have a book recommendation or what are you reading right now?
I'll always suggest Investing in Private Equity Real Estate by Sean Cook. It's a great, quick read. It very easily explains the GPLP fund structures, syndication structures. It's just a great overall. If you're looking to either raise money to do your own deals or invest passively in other people's deals, it's a great way to get a really good understanding on really simple terms of what the industry looks like and how it operates.
What single strategy, process, or tool have you implemented that has had the biggest time saving impact to you or your business?
Going more into the operating business side is it's EOS, the entrepreneurial operating system. A lot of people are familiar with that, but it's kind of a corporate structure for small companies. And so it gives a framework of how you do your weekly meetings, how you set targets, how you set goals, how you set to dos throughout your team. And that has been very important for us. Traditional real estate guys or deal junkies out there running around like chickens with their heads cut off doing deals. And so it's good to have that structure that kind of brings us back to home base and puts a framework around what we're doing.
And if people are interested, that traction book is a great place to start
Yeah.
there.
That's where I feel like everyone starts the retraction. Like we got to do this. So it's hard to implement, but if you can do it and get your team on board, it's a great tool.
One last time, stoicep.com. That's going to be a clickable link in the show notes. Grant, this was a fantastic conversation. I really appreciate meeting you and all the value you brought today.
Yeah, I really appreciate you having me on. It was a great conversation. I really enjoyed it.